Today, the Nasdaq officially entered bear market territory after falling by more than 20% from its all-time highs that were set just a little over a month ago. So, needless to say, the last 3 or 4 weeks have been brutal to be an investor in the stock market. And today was one of the worst days in recorded history, with the Nasdaq falling by more than 6%. The Nasdaq today is down by 6.21%, and people everywhere are talking about how this is just the start of the second Great Depression. Now, this is very interesting because right now, current economic data continues to come in much stronger than expected, yet people's outlooks for the economy and their outlooks for their future are they're in the toilet, and there's no other way to explain it. Right now, present conditions are phenomenal. They're great. Unemployment is at a historical low. People are making more and more money. Wage growth continues to be very strong. But people are fearful that the Great Depression 2.0 just started. Let's talk about this. One of the biggest pieces of economic data we got this week was Challenger announced job layoffs. So that's what it is. It's employers firing employees. And over the last 2 months, Challenger job layoffs have been surging, and they are now at levels that we've only seen 3 times in the last 2 decades: 2020, 2008, and 2001 or 2002. Both of those time periods marked tops in the stock market and tops for the economy. Most people will stop their research there, but you guys know I go a little bit deeper on this channel. We can actually look at all of the sectors that contribute to Challenger job layoffs and see that almost 217 announced job layoffs came from the government sector in the month of March. So if we go back to the previous chart really quickly, basically all of this surge in announced layoffs has come from manufactured layoffs at the government level. This is not the same scenario or the same situation that we had in the 3 previous time periods that I just talked about. This was planned, manufactured layoffs of workers at government agencies. Better yet, this morning's employment report was very positive. It showed a much stronger gain to payrolls than basically any forecaster was forecasting. The jobs market is still very, very strong. Wage growth is still very, very strong. I know I already said that, but that is so key. If you're going to see a recession or a depression, you have to have the labor market fall through. You have to have wage growth slow. As long as wage growth is strong, people are going to have money to save, to spend, and invest in the economy. Now, I see investors falling for a trap, and it kind of hurts my heart a little bit, where the broad market is selling off, and the riskier you are with your portfolio, the more your portfolio has fallen. This is kind of the way it works. When the stock market does well, your portfolio is going to outperform. But when the stock market does poorly, your portfolio is going to underperform. Just the way it is. But a lot of investors, retail investors, have completely capitulated. They're out of the markets. They're in so much fear. There's so much uncertainty, and they have so much doubt that they have sold out of all of their companies, and they think the companies they held are bad companies because their stock prices were falling. They fail to recognize that the reason that these individual stock prices have been falling is not because of what the companies themselves are doing operationally. The stock prices haven't really been a reflection of how good or bad these companies are operationally. Their stock prices have been crashing because the markets just want to sell everything. And I think in a lot of cases right now, the selling is forced selling. Investors are getting margin called. They're being forced to sell assets that they hold, which makes them sell their stocks. But this is exactly what presents opportunity. As much as it hurts my heart that investors are falling for this trap, believing that the companies they own are bad companies because their stock prices have fallen, that's what opens up the door to opportunity. Warren Buffett himself has said that the price action of a stock should not dictate whether or not you keep holding that stock or even buy more of that stock. He says you need to focus on the company's operations, the long-term growth of the company, and compare that to what you might be able to get elsewhere, the opportunity cost in the stock market. That's what you need to pay attention to. Right now, there's way too much focus on short-term stock price performance and not enough focus on long-term operations and growth of these companies. So right now, the markets are selling some bargain deals out there. And I myself, I'm taking advantage of them. And I plan to keep taking advantage of them. And people might call me stupid while I do that. But I know based on 200 plus years of stock market history that is the right decision right now. There's no refuting that. 200 plus years of history. But just to give you an example of this, let's focus on NVIDIA. NVIDIA, everybody knows they're a strong company. They have a great management team. They've executed very well. Every earnings they have, they come in and they beat their expectations. They outperform, yet since the end of last year, NVIDIA stock has fallen by 40%. Does the stock price falling 40% reflect a struggling business at NVIDIA? Does it reflect a management team that is very poor and doesn't execute? Does it reflect that the company's growth is going to go negative in future years? I think the answer to those questions is fairly obvious. Now, I'm not saying that the AI trade wasn't getting too hot. In fact, I was one of the only people on the internet that had the cojones to come out and talk about it. In late January, I said, I think I'm moving my short-term market outlook to bearish because I think the AI trade has mostly run its course. And well, just like is so often the case, I had a lot of doubters, a lot of people calling me names, saying I don't know what I'm talking about. I'm not saying I'm always going to be right, but it's actually usually a pretty good sign if most investors don't agree with you, if your opinion is the contrarian viewpoint and not the popular viewpoint. If that's the case, you're usually correct. So if you're getting, negative feedback, people are insulting you, people are calling you dumb or stupid, saying you don't know what you're talking about, most of the time, you're actually the one at the end of the day that's going to be proven correct. And right now, the consensus view is sell everything. Sell everything. This is the end of the United States of America. Our economy is going to experience the second Great Depression. Get your hands off any assets you have now. But the fact that that's the consensus viewpoint right now makes me wholeheartedly believe that that's not going to be the case at all. We can quickly look at the CNN Fear and Greed Index, and I quite honestly don't know if I've ever seen this index as low as it is. It's at 4. It's a scale of 0 to 100, and we are at extreme fear with a number of 4. Everybody out there is fearful. Everybody out there is uncertain. Everybody out there is doubting, which means that, well, anybody that's going to sell their stocks is likely doing so currently, but a lot of people in the markets won't recognize that, and, well, they'll just chase higher prices at the end of the day. Now, this chart here shows you forward PE multiples, basically valuations of the public companies in our stock market. And you can see that the Magnificent Seven has been hit the hardest. And fun fact, I just remembered this. When I came out and said I thought the AI trade had mostly run its course, I actually entered a short position on the Magnificent Seven. That was met with a lot of criticism, but it ended up being the right move. I didn't hold on to that short nearly long enough, but we did make some gains on that, and it's added to our cash position that we can plow back into the markets. So I'm excited about it, but it's been the Magnificent Seven that's been hit the hardest, with their forward PE multiple falling from basically 31 to 32 all the way down to 24 right now. 24. And this is investors, and it's another thing investors don't realize. A valuation reset for the Magnificent Seven in particular is probably one of the best things that can happen for the stock market's outlook for the rest of the 2020s, because there's two things that make stock prices rise. It's either earnings expansion or it's multiple expansion. When you are in a scenario where you can have both of those things happen at the same time, that's when you get explosive stock market returns. The Magnificent Seven's growth is not projected to slow, and, well, their valuations are now coming back down to earth, which means, voila, there's room for both multiple expansion and earnings expansion as we get closer and closer to 2030. This is one of the most healthy things that can happen for our stock market, but people are losing their minds because everybody was on one side of the trade, and that was in the Magnificent Seven. That's all that has led the stock market over the last 3 or 4 years. It's been the Mag 7. And everybody, just like sheep, filed in to the Magnificent Seven, and they've forgotten about the rest of the stock market. It's kind of interesting how things work. Now, there's a quote out there that I really like, and I wish I had, I don't know who the quote-unquote author is of this, but the quote goes like this: "It is uncertainty far more than disaster that unnerves and weakens markets." We've already talked about how the economy right now is very, very strong. People are doing really, really well right now when you compare our current economy to historical standards. It's very strong, but people are so fearful. Their outlooks for the economy, their outlooks for their future are so negative. And yeah, part of that is, well, the leader of our country has flat out told us that there will be short-term pain in order to reach this golden age. That's a very, very difficult thing to sell to American consumers, that, well, okay, I'm going to stomach short-term pain just so we can have the golden age. No, it's pretty hard to sell, and Trump, he's not going to be able to continue to sell that for much longer because midterm elections are going to start firing up here, and well, he can't afford to lose ground in the midterms. Otherwise, he won't be able to do anything that he wants to do. It's another thing the markets aren't focused on right now. So this is purely uncertainty and fear and doubt driving the stock market's panic. It's not current disaster. It's not at all current disaster. But, we do need to pay attention to sentiment because sentiment can change behavior. That's the one time sentiment does matter, is if it changes consumer behavior, where consumers spend less because they're less optimistic about their futures, where they invest less because of all the uncertainty, and where, well, maybe they end up saving less at the end of the day if wages start to crumble and wage growth starts to crumble. That's when things can get bleak, but right now we're really not seeing much of that. Retail sales data. We can look at Redbook retail sales. I won't pull up the chart in this video, but I've done it in the last several videos. Retail sales, according to Redbook, still very strong. Consumer spending, still really strong. Private sector investment, trillions of dollars since Trump was inaugurated. But markets don't want to focus on the positives. They're just solely focused on the negatives. And sure, there are negatives that come along with these tariffs that Trump announced just a couple of days ago. In my opinion, the markets are just now finally recognizing what tariffs actually are. There's been this complete bullcrap in the media that tariffs are going to cause consumer inflation. We can look at time periods in the past where tariffs were increased exponentially and see that very little, if any, inflation actually hit the consumer at the end of the day. It's because it's very hard to pass extra costs onto the consumer. Because, well, we like our cheap goods. And if you pass on extra costs, it usually leads to sales plunging, which at the end of the day leads companies to just revert their price increases to bring back sales. It's a very, very difficult thing to do in our capitalistic economy. And really, to prove this point further, corporations are scared of tariffs right now. They realize, just like the markets have started to realize, that tariffs are a direct tax on corporate profit margins. Corporations wouldn't care about tariffs if they could just go out and pass on the extra cost to the consumer at the end of the day, because their numbers wouldn't change. The corporation's numbers would stay the same, their profit margins would stay the same, their sales numbers would stay the same. But that's not the case because they can't pass on the cost to the consumer. That's why they're nervous about tariffs. And rightfully so, profit margins are going to be hit, but profit margins are at all-time highs. Corporations nowadays have the ability to, well, take a hit in their profit margins, a one-time hit in their profit margins, better than any other time period in history. So more so than ever, a slight hit to profit margins at our corporations risks recession or depression less than it ever has in the past. And the bottom line is we already know what happens when tariffs are increased. This chart shows it. Construction spending on factories in billions of dollars. This shot up 200% from the end of 2021 until present day, where every year in our country we are spending $240 billion constructing new factories. Again, this is only the construction cost. This isn't the cost for computers or tools or whatever is needed to fill these factories to produce goods and services. This is purely construction spending. And this has a very positive short-term and longer-term impact on the economy. The reason that we didn't see the effects of these tariffs, leading to increased construction spending until 2021 and 2022 is because, well, it's a multi-year long process to plan and execute new facilities, to construct those new facilities. It takes years. And, well, we also had a pandemic take place, kind of between these tariffs being announced and when we actually saw the construction spend come through. Tariffs largely stayed the same under Biden's presidency, and he actually stimulated this even more so by the CHIPS Act and in a couple other acts that he passed while he was the president. That's why construction spending has absolutely ballooned, and we can expect the same exact thing to happen again from private sector investment, well, as companies and corporations move their production back to the domestic United States of America. A very, very positive thing for the economy. Sure, is it going to be short-term pain? Absolutely. It's going to take 2 or 3 years before this construction spend really comes through in the numbers and benefits the economy. But that's what Trump's talking about. Short-term pain for longer-term gain. So when will the stock market stop its panic attack? When will stocks start to move higher? I wish I had a crystal ball and I could 100% tell you when it's going to happen, but I don't. I'm just going to give you my best guess, my best analysis, my best opinion here. We need sentiment to reverse. Right now, sentiment is in the doldrums. It's as low as it can probably get in all reality. But we're in a unique time period where good economic or strong economic news is not going to be enough to reverse current sentiment, because people are so convinced that regardless of the positive economic development and data that we're getting, the future is very, very bleak. That's what they believe. So any current good or positive economic numbers, it's not going to do much to shift sentiment from investors or consumers or businesses. What we really need to happen is for tariff talk to morph into trade barriers coming down, trade deals getting signed, unlocking free trade and really unlocking the potential for further worldwide economic growth. But for as long as tariffs are leading to increased trade barriers rather than decreased trade barriers, things could stay choppy. Things could stay very, very volatile. But that's the one thing I think we need to keep an eye on. And already today, we've had several smaller countries announce plans to negotiate deals with President Trump to basically to create free trade again, where both sides bring their tariffs to 0%. And that's a great start. Smaller countries, that's a great start. But we need China. We need the EU. We need Mexico. We need Canada. We need those big, large economies to do the same thing in order for us to really feel the benefits of it. But for the time being, this excites me. A lot of companies operationally are stronger than they have been in their entire history. And operationally, they keep improving and growing stronger. Yet the markets don't want to touch those assets with a 10-foot pole. That's what creates opportunity. And I plan on taking advantage of those opportunities, continuing to do so. I do have a Patreon portfolio. You get to support what I do. I'm entirely independent and self-funded. So your monthly support means a lot to me. I think we have 250 paid monthly members. So thank you guys so much. If you're interested in that, hit the Patreon link in the pinned comment down below, or hit the join button located right next to the subscribe button. You'll join the members Discord server and see more of my thoughts on the current economy, what I'm buying and selling, things like that. So if that interests you, check that out. But first and foremost, spend your extra cash buying stocks, in my personal opinion, rather than on my membership. But if you do have extra cash at the end of the day, it does mean a lot to me that monthly support that you guys show. With that, I hope you guys have a great weekend. I'm going to try and keep this video somewhat short, knowing that it is Friday evening. I hope this kind of gives you some peace of mind, some clarity that, they're painful short term. They might be painful for a few more days, might be a couple more weeks. Who really knows? But we know where things are headed. And the markets right now are focused exclusively on the negatives rather than the many positives that we can point to in the economy. And that's creating opportunity for us. But with that, I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.